Imagine this, you just received a certificate of registration for your partnership company. Now you're ready to conquer the business world. But wait, do you know the most common mistakes that can sink your partnership firm? In today's video, we'll not only reveal these pitfalls but also guide you through the essential compliance steps that will keep your partnership thriving. Stay tuned. But before that, in our previous video, we talked about formation of partnership firm, why should someone choose a partnership firm, how do you establish a partnership firm, how many partners can you have in a partnership firm, advantages, registration procedures and documents, registered versus unregistered partnership firm, closing a partnership firm, cost of registering a partnership firm. If you missed watching that video, please tap on the link in the description to watch it. Getting the certificate of registration for your partnership company is an exciting milestone in your business startup. You have likely gathered the necessary documents as per the Ministry of Corporate Affairs guideline. With the help of a Zolvik professional who have assisted you in obtaining the certification for your partnership registration. However, receiving the certificate of incorporation is just the starting point of a series of compliance obligations that a partnership companies must adhere to under various Indian legislation. They are partnership agreement. Once partnership company is officially established, the partners have a crucial task at hand. They must draft a partnership agreement and ensure to submit a copy to the registrar or the companies of company's formation. If you're not registering the partnership company, then there is no need to register with the ROC. Application for permanent account number. To ensure smooth tax compliance, every company must obtain a permanent account number, which is PAN, from the Income Tax Department of Government of India. This PAN serves as a unique identification number for tax purposes under the Income Tax Act. To secure a PAN, the company needs to submit an application along with a copy of its certificate of incorporation. Then comes application for tax deduction and collection account number TAN. Each partnership company must acquire a tax deduction and collection account number from the Income Tax Department of the Indian government. In case where specific payments trigger tax deduction at source, a portion of the amount must be deducted and remitted to the government. Having a tax deduction and collection account number is crucial for facilitating TDS remittance. Opening bank account in partnership company's name. Following the partnership formation, establishing a current account in the company's name with any bank in India becomes very crucial. All transactions linked to the partnership company should exclusively occur through this designated company's bank account. Remember, the specific requirements, documents, and the initial deposit may vary from one bank to the other. Some bank even offers zero balance current account, which is subject to specific condition. Books and accounts of partnership company. Maintaining accurate books of accounts and recording all income and expenses in a mandatory step in accordance with the Companies Act and other relevant laws. These financial records and statements must accurately reflect the company's overall status, including any branch offices it operates. Bookkeeping and accounting start with recording transactions such as receipts and payments. It's recommended to have physical records for each transaction. Shops and establishment registration. All business establishments must obtain a shop and establishment license as mandated by the respective state shop and establishment acts and rules. This license is necessary for all businesses and establishments depending on the regulations of each state. Therefore, partnership companies must obtain this license in each state where they have offices and establishment. Compliance with applicable laws and regulation is essential. Professional tax registration, employer and employee. Another registration that must be obtained after incorporation is professional tax employer registration. This state-specific labor registration is mandatory for all registered businesses. Whether or not they have employee, it needs annual renewal by paying the prescribed fee. Please note that delaying registration can result in a yearly penalties. Additionally, if the company employs individuals whose salaries exceeds the specific limit, which might vary from state to state, they must obtain a professional tax employee registration, which is a registration certificate upon hiring employee. In this case, partners are considered as employees if they received salaries beyond the specified limits. The employer is responsible for deducting professional tax from the employee's salary and remitting it to the state government on a monthly basis. Goods and services tax registration. For goods related businesses making over 40 lakh in a year and service providers making over 20 lakh, signing up for GST under Goods and Service Tax Acts and Rule is very essential. It is not an immediate requirement upon partnership company formation. You can obtain it when necessary. However, if your company needs to provide its GST to other businesses or authorities, securing the GST registration right after your company's official registration is recommended. Filing of income tax return. Every company has specific deadline for filing income tax return. If the partnership company doesn't require an audit, that is, the deadline is July 31st. For partnership companies that need an audit, the deadline is earlier, on October 31st. Meeting these deadlines ensures the partnership company fulfills its financial reporting obligations to the government and relevant authorities. Mandatory audit of accounts. Finally, the financial record of each company must undergo an audit. The following guidelines stated in Rule 24 of the LLP Rules of 2009 should be followed. These rules outline that any partnership company with a turnover below 40 lakh rupees or a contribution below 25 lakh in any given financial year is exempt from the mandatory audit of their accounts. You can now experience seamless guidance in incorporating your partnership company and managing all compliance related tasks by connecting with us Solvit in-house chartered accountants and company secretaries. Our experts are here to ensure that you stay ahead of the game when it comes to mandatory registration and compliance obligation. By the way, do not forget to like, share and subscribe to Vakilsearch YouTube channel. You know why? Because we update valuable content like this every week. So click on the bell icon so you stay ahead of the updates and notification from the government.